All right, thank you. So hello, everyone. I'm Mary Henry. I'm part of the volunteer committee that sets up the MIT CFO Summit every year. Excited to be here. I'm going to introduce Liz Wall, who's with McKinsey, and she's going to be the moderator, and she's going to be introducing everyone and kicking us off. So please give a round of welcome to all of our panelists.
Thank you. Thanks, Mary. Hello, everyone. Thrilled to be here. My name's Liz Wall. I'm a partner with McKinsey & Company in our New York office, and I lead our client service globally around M&A capability building with lots of deals in the healthcare sector, but outside as well. But most importantly, super excited to be with these fabulous panelists today, talking about M&A and deal making and capital raising in what is certainly an interesting environment, as these folks have plenty to say about it. So we have about an hour here, a little less than an hour. We'll have our fabulous panelists do introductions momentarily. I will lead through some questions that these folks have some really pretty amazing stories around, and then we'll leave 10, 15 minutes at the end for any questions from you all. So without further ado, would love to start with Joanne at the end and ask for quick introductions.
Hi, I'm Joanne. I was the CFO of Patient Ping, and we sold the company for $500 million in the spring of 2021 as my last transaction. And I joined a new company called Jellyfish, and we raised $70 million in December of 2021. So that's the context of what I'm going to be talking about today.
Amanda.
I'm the CFO of Boston Dynamics. I'm Amanda Barber. And the latest round was about $1.1 billion recap of Boston Dynamics in what felt like 2020, 2021, took a little time. So that'll probably be the context for me.
I'm Scott Almeida, and I'm with Recorded Future. I've been there since 2013, and over that time we raised some money. We got bought by a private equity firm, and in the last year and a half, we've bought a few companies, and so that's kind of the context of where I'm coming in.
Great. Hi, I'm Dave Dakota. It's a pleasure to be here again. This is my second year back, so looking forward to the conversation. I co-head the Americas M&A practice for UBS. I've been M&A practitioner, so to speak, for the better part of almost 25 years now, with the gray hair to show for it, and work with public companies, private companies, financial sponsors, domestic transactions, international cross-border transactions, large and small. So we'll have a lot of history across that continuum and spectrum, and I know a lot of that is represented in this room. So looking forward to the conversation.
Great, thanks all. So let's kick off. Timing is a topic that's on everyone's mind right now, for sure. How do you guys think about timing in the context of a transaction? Can you influence it? Can you predict it? What does that look like? What about gaining conviction around striking when the iron is hot? How do you figure that out? And so, Joanne, maybe I'll start with you.
Sure. So Patient Ping, as I mentioned, we sold in March of 2021, and that wasn't really the first time we had looked at doing a transaction. About 6 or 9 months earlier, we had looked at combining with another company and just couldn't get agreement on valuation terms. So a couple months later, that company got sold and almost created a benchmark for us and kind of a fear of FOMO from other strategic buyers, and we started a process. So we started a process at the end of January of 2021 and had an LOI by March of 2021, 6 weeks later. And and you asked whether we can influence or not. I don't think we really can, because we got this LOI that said, oh, we have 10 days of due diligence. And I was like, oh, great, I'm going on a spring break with my kids in 14 days. So I'm going to try to finish this due diligence in 10 days and get to definitive agreement. I'm on the plane emailing the CEO of the acquiring company. I open my laptop at the airport. So really, I don't think we can influence a lot of the timing, but I do think you can be ready when you need to be ready and just grab the situation as things are always changing. So.
Thanks, Sean. Dave, maybe a little bit from a macro perspective and what you see around, public markets, private markets.
Yeah, I think on the timing question as it relates to that, I think if I could predict that, and I've been wrong a lot, I'd probably be on the investing side of the equation. But I think generally you can feel when the market is hot. You mentioned FOMO. I think for a number of years you could say things were very active. Could have said that 2 years ago, 3 years ago, but the reality is that it has been for quite some time, and you never quite know when the music is going to stop. And having had the benefit of doing this for almost 25 years, I've seen cycles going back to the internet bubble and all that kind of stuff. So there is a little bit of a rhythm to it. I think as we sit here today, we're in a very different environment in terms of just the macro as it relates to M&A. Not surprisingly, I think anyone can look at public company stock prices, and that's a pretty decent gauge as to kind of where the M&A market is. But I think putting where we are this year in context, compared to last year, which was a record high market by any measure, that year-over-year comparison I don't think is the right one. I think you have to look a little bit further back. And we're actually in a pretty decent place for 2022, interestingly enough. A lot of that, I think, was done earlier in the year. As we sit here right now, the market certainly has quieted in terms of M&A activity. A lot of that is driven by, I think, value expectations. There's definitely a lag in terms of how private investors think about valuation relative to where the public market is. The public market tends to lead. So as you've seen the valuations in the public market decline, there's generally a pretty decent lag. I don't want to be too precise about it, but think maybe 6 months, maybe longer, maybe less, depending on the cycle. But it definitely does take time for owners of businesses to sort of recalibrate to what the new normal is. I don't think we're quite necessarily there yet because the market's still pretty volatile. So I think the public market's a pretty good gauge. What's also happened is the financing environment is significantly worse today than what it was even 6 to 9 months ago. So when you think about a sale process that would involve debt financing, you have to think real hard about how financing factors into it, because certainly if your buyer universe is weighted towards financial sponsors, that drives a lot of how they think about returns. Now, earlier stage companies that are growth oriented, there's a bit of a different dynamic there, but as far as cash flow generating businesses are concerned that are leverageable, the financing market does have an impact on buyer appetite and what they're willing to pay in terms of valuation, because it's really just an IRR-based analysis that also factors in the valuation environment. And so right now, you've got a fairly dysfunctional financing market, and if a process hasn't already been kicked off in terms of a sale process, basically everybody's in kind of wait and see mode. And really wait means waiting for some stability. I think there's a realization that cost of capital has gone up. I don't think it's going back down to where it was a year ago, but where's it going to settle? I think that's an element as well that factors into timing in the macro environment.
Kind of a related question here, and Scott, maybe I'll start with you, but how important is speed in doing a transaction? And, is that actually a competitive advantage in some situations? And you had shared with me at some point a story about being diligence ready every day, and I'd love for you to speak a little bit about that.
Yeah, sure. So I think the reason I got the job that I have that long ago was because during the interview process, I actually said one of my goals in any company I go into is to be diligence ready every day. And so, that's a very lofty goal, and you're never always diligent ready, but you can be as close as you can, having documents electronically, having your cap table up to date, like all the kind of basic blocking and tackling. And so it does help when you can be ready when someone does knock at the door. I think the last round of financing we did in under 30 days from start to finish, which our lawyer who had been at Foley Hoag for, I think, 50 years said was a record for him. And then even on the transaction, when Insight, our owner now, bought us in 2019, I think that was 60 days from start to finish. Granted, they were already an investor, so it did make it a little easy. But having your ducks in a row, I think, just really matters. And yeah, you're not going to be able to influence, the speed as we talked about before. But being ready, it really does make a difference, and it makes it much easier to kind of, for those other people to get comfortable with you. And I think that's one of the biggest things, because if you can, like, now is a great time to get ready. Not a lot of people are knocking on doors, and if they are, they're going to be offering you not as much money as you might like. And so now is a great time to get the metrics ready, get all the reporting ready, all those things that you can just have in place, so when someone does and markets do open, you can be ready for them. It just makes everything easier. And maybe you can make your vacation.
Amanda, it would be great to get you on the same topic, but in addition, also, what about the role of due diligence being done virtually? Is that over? Are we still in that world? What's that going to look like?
Yeah, I don't know. I'm like dare to dream. I wish we were diligence ready. I think we're in different types of businesses. It's like changing tires on a moving car usually. I think, yeah, I don't see virtual going away. I think that's kind of the new normal. I don't know if, I'm sure all of our interactions with the Big Four, anything like that is still done. All of the McKinseys of the world might be out, but everyone else is still at home, I think, taking them at least partially. So yeah, having everything be virtual, having a path towards it, being creative, I think, is kind of the new normal now too. If you don't have your ducks in a row, as you said, you have to be thinking about what are you using to run the business, what management reporting are you using that you could then, kind of bubblegum and spit together to get where you need to be. Yeah.
Dave, you have a pretty incredible cross-sector, cross-organization view. When things do open up and the financing markets do unlock, can speed be a competitive advantage when it comes to doing these transactions?
I think it can be, in the sense that it just provides, it's a more efficient process, as Scott alluded to, and I couldn't agree more in terms of being ready. And I don't think that's necessarily saying that you're doing anything different than what you should be doing running the business every day, right? I'm consistently amazed at the difference in quality within the finance function across companies. And those who are really financially savvy, prepared, as Scott described, it makes a tremendous difference in terms of just efficiency, the level of conviction that the management team has with the business, how that is then conveyed to the buyer. I can't overstate that enough. And so having things like KPIs and all that at the ready, which I would think, you would think, right, most companies would want all that as part of running their business, but the reality is it doesn't actually happen in a lot of the cases. So to me, that's a very important element. And it helps you, when we sort of work with companies, I'm a big advocate of significant upfront preparation. So by the time you actually make the outreach, you've pretty much answered all the questions that you know are going to be coming, right? And that goes to the preparation phase. And that just makes all the interactions that much more efficient, right? Providing KPI packs early, not just the old days of you get an info memo and somebody says okay and puts a multiple on it and here's your bid. Like that, I think those, in my opinion, those days are over or should be over. The onus is really on management teams and their advisors to be comprehensive earlier in the process, because then it really makes, one, it allows you to sort of delineate as to who on the other side of the table is actually more serious, because they're spending the time and effort to really understand the business and dig into the details. And two, it helps that latter phase of the process move that much quicker. So you're kind of giving them more information up front to facilitate speed on the back end. So I do think there is a competitive advantage element there as well. Obviously, you got to be commercially sensitive. If there's any sensitive information, you don't want to provide that to a competitor. But on balance, I think more sooner and more preparation sooner is helpful.
Well, at the risk of having objects thrown at me, given our audience here, there's a perception that CFOs are very focused on the transaction itself, right? And then kind of done with it, perception. What about integration planning? What about actual value capture, value realization? How can CFOs remain committed throughout that process and really driving, value realization? And so, Amanda, it'd be great to hear from you a little bit on, the importance of integration planning and go-to-market approach, and like when do you actually really start thinking through those details?
yeah, that's, so the same way we're talking about be prepared, I think that's number one. So I care very much about, how are your products going to align with whether it's buy or sell side, are your products aligning? Are you getting some sort of tech that is going to be a longer tail, and you have to get investors excited about it? I think that you have to be thinking about the synergies and, is this a strategic investment so that you're, really moving the business forward? Is it, a defensive posture where you're acquiring some IP and it's, it's not something that is as sexy maybe that everyone, can look at and understand the value. It helps craft the story. I think it keeps investors excited and feeling like everyone is aligned.
Joanne, how have you kind of partnered with operators in that kind of integration value realization phase?
Being the acquired company, I've also been on the acquiring side and what Amanda said, but being on the acquired side, you take a lot of lead for, you look at the acquiring company and you work with them and bring in the right people. You know your business, and you can introduce the right people to the acquiring company. As a CFO, I think a lot of your role is also kind of like a stewardess's role during a turbulent time. Like, people are looking at your face and saying, like, how are you thinking about this transaction? What do you think about this? And I think a lot of what, as a CFO, you do is, provide calmness. Like, if you are saying excited about it and excited about the future of a combined company, you can also do a lot of benefit as you roll up the company together.
Thanks. What about the role of founders in the go-forward plan? And Scott, it would be great if you can talk a little bit about that, and anyone else who wants to chime in.
Yeah, we've acquired a few companies recently, and they all have founder CEOs. And so it can vary in a lot of ways. I think one of the things that we try to do is keep them important. I think back to when I was at a company that was acquired, and as I feel like I was the right-hand person to the CEO there, and then the day the company was acquired, I was useless. I couldn't sign a check. I couldn't sign it. The new company is like, all right, Scott, in 6 months we'll see you. But when you've got a CEO who's a founder and you want what they bring to the table, which oftentimes you do, it's super important to kind of, keep them important. So whether it's they're running their product, whether it's you find some other project for them to work on, but also treat them with respect. I think, things can go in a lot of different directions. And, in some cases, you may even just say, you know what? You're ready to go off and do your next thing. We'll back you on it. We'll work with you on it. So there's all different ways, but I think it is very important to remember that these were people who were running their organization. They have a passion for it, and they can probably bring a lot to the table if you can kind of bring them along with you.
I think the two questions that you asked kind of go hand in hand, because integration and how to deal with not just the founder, but with management. To me, the more you do that up front, such that when the deal closes, you're already well along that journey, the better off you're going to be. I mean, waiting till later is not really a good alternative. And having that discussion when you're talking about founders, clearly with the senior team of the buyer, with the founder, defining the role, defining the path, talking about the integration plan, incorporating the team of the acquired company in that discussion as well. I mean, it does vary, right? Because there's different size targets and all that kind of stuff. So I don't mean to oversimplify it, but I think the time and effort up front to have that discussion and alignment of what the path looks like is very important.
I think of that as part of our job, right? It's not just looking at the transaction financially, but what are all the players around it that are going to influence it and influence the value capture long term. And if you have founders in there that they could be brilliant, but if they're a distraction from the business and they're going to create more chaos when in an already challenging environment, integration is always challenging. So I think it's important to know going into it that you might need to part ways with them or to say support them in other adventures they're going to go on.
I'll give you one example. During the integration time before the deals were consummated, one of the things that came up was whether we were going to keep Slack or not. So our company culture was we all used Slack, and the acquiring company, they used Microsoft, and they were saying they wanted Teams, and they were like, it's the same thing. We're gonna replace Slack. And as a finance person, you know your culture. You know what and I had to go to bat and say, you know what, you're gonna lose a lot of our engineers if you make them go to Teams. Like, they don't want to work for a company culture that's that way. And so kind of because of your involvement in the company and you kind of really know those things, you know what are the important things.
Yeah.
Yeah.
What's my email address going to be? Scott, you have quite the track record of doing a series of integrations of smaller companies. What are some 1 or 2 lessons learned from that?
Oh gosh. I think some of the things that we've done well is trying to move quickly on, bringing people over and under the tent. And when you drag your feet on it, which we've done also, it can really cause problems further down the road. And trying to get as much stuff done ahead of time, you'll have a CEO who wants everything done. Let's just sign. Let's own the company. But doing the sign and close, enforcing a lot of those issues between that time, it just can solve so many problems further down the road. So I think that's one of the bigger things, just to put that space in between where everybody still is trying to get to the end, and so they're much more motivated to do things that maybe they would be less motivated to do otherwise. But that's probably one of the biggest things. And then also just not overwhelming them. I was talking to someone yesterday, and they described an acquisition that they had done, and it was I think a 6-person company, and they sent down a team of 14 people. And it's like, so one of the things that we did when we acquired one company, the CEO sent an email to our entire company and said, no one can email them. When they come on board, you can't email them, just stop. We'll let you get integrated, we'll let you eventually talk to them, but on day 1, day 2, for the first month, you are not gonna email them, because you imagine a 900-person company, acquires a 20-person company, and all with great intentions. Hey, welcome aboard. All of a sudden, welcome aboard, welcome aboard, welcome aboard. It just gets too much for folks. So I think not quashing them either, I think, is super important. And and then the respecting the culture is just, you have to do that. So
Presumably someone at least said hello.
lots of people did, just not 900.
Oh, good.
Yeah.
Maybe you'll go down the line here, starting with Joanne. What surprised you most about the most recent transaction, or one of the most recent transactions you worked on?
The last transaction was the fundraise at Jellyfish, where we raised $70 million. And I started at the company in August of 2021, and we started a fundraise in October of 2021. And I was the first finance hire, and I didn't have a team. It was me. And so we had no data room. We had a spreadsheet with our financials. We got 6 term sheets in 2 weeks. The last term sheet, we gave them the spreadsheet at 9 a.m., and we got the term sheet at 3 p.m. And we closed in 2 weeks after that. So that was super surprising. I've done a lot of fundraisers. I've never done one so fast and so easy. There were 2 follow-on investors and one new investor, but it just went really, really fast. And it was a different time. This was December 2021, very frothy market, and I do think leaders in their space are able to raise, and when we knew that things everyone who's been here and been in finance a long time, you see the ups and downs, and you know that, good times will not last forever, and bad times won't last forever. So we're just patient and just grab capital when we can and work on that. Yeah.
Amanda, most surprising thing about your last transaction?
I started similar to you, started in February of 2020. And so a global pandemic was pretty surprising. And then, having everything that I know now, I'm sure we've all seen the WeWork stories and the SoftBank stories. When you're in it, you don't really know what's going on. You just know all of a sudden you need to be raising capital in about 2 months. So in a company that had only been selling, we're at very early technology, right? Robotics. Boston Dynamics had been a research company for 28 years, but a commercial company for 4 months when I started. So trying to, raise $1 billion in that market in a very interesting way was fun. It was exciting, but it was different. Yeah, similar. They didn't have a balance sheet to speak of, meaning like literally their chart of accounts didn't exist because they had been a research organization. So it was building everything, implementing an ERP system, fundraising, building an entire finance team, all in a year, so that we could do it. So it was intense and it was a fun ride. I don't know if I'd recommend.
So the last transaction we did, we bought a small company out of the Netherlands, and very small, and they had about $2 million of recurring revenue, roughly. It was one of those where spreadsheet kind of, not really, a few documents, but not all. And so I think one of the funniest things was the head of sales. I mean, to call the person the head of sales was really, he would refuse that title because he didn't want to do it. It was just one of the guys who, well, you do that now. And so that was just like one of the funniest, most surprising things is like, well, how do you know if you're going to get an order? I don't know, we talk to someone and then, they eventually send one over if they do or they don't. And it was just so funny to see that kind of, and really the passion was for the product. It wasn't for trying to monetize it. They ran a cash flow positive business, but really it wasn't about the, trying to grow it at all costs or anything like that. So it was just an interesting story. And again, just this head of sales who was like, oh no, I don't want to do that. I want to be an engineer. Can I go back to that now that you guys own us? And so, fun company.
Yeah, I guess there's a couple things I'd say. I was really surprised at the pace at which M&A continued during the work from home environment. I mean, it was the best year in M&A last year in history by a long margin. And there were very few face-to-face meetings during that time. I'm not sure I would want to go back to that either, to Scott's point. But I think there was a transaction that I had worked on this year, 2 private companies, each with very complicated ownership structures. Many of the big financial institutions have ownership in each of these businesses. There was overlapping shareholder bases, and it's a business that basically is a platform to help big financial institutions manage their alternative investment portfolio and interact with their end customers. And each of these 2 companies had raised capital, I think December of 2021, and one had done so just previously as well during very peppy times, right, where you're talking about multiples of revenue that are double-digit kind of thing. And there was that transaction was struck during, a little bit after that, but really on a relative value basis because they were in, similar industries, and there were two companies that were coming together. So it was an all equity deal, and in the midst of all this, basically the market cratered, right? So valuations started to plummet. The double-digit revenue multiples very quickly became, mid-high single-digit. And I think to the owners and to the respective management team's credit, they sort of stayed the course. And I think a lot of that was a function of the fact that, again, it was a relative valuation discussion, right? And it was an equity deal. If it was a cash deal, I can guarantee you it never would have happened. And so, the respective owners kind of understood the benefits of putting the companies together. They put aside what the historical valuation marks were, and it was really more about our company's worth this, and we should be worth that on a relative basis. So it actually ultimately worked out. And it was also one that touched on some of the things that we talked about earlier, which are both of these institutions were founder-led, and very strong personalities. But our client, who effectively was the acquirer, did a fantastic job of defining a role for the CEO of the other company. Really, and in this instance, they continued to run effectively the business that this individual, he had run before. Now, there was going to be integration and all that, because that was part of the shared vision. But there was a tremendous amount of time that was spent not just on that governance aspect, but the broader governance the broader governance package, given this ownership complexity. And at the time, I was thinking, oh my God, here we go again. But the reality of having gone through that admittedly very painful exercise is that, 6 months later, we had a dinner with each of the teams were together, they're functioning well, everybody's happy, the business is really just humming, and it really is a testament to all the work that was done up front before the deal was actually signed. So I think re-emphasizing some of the points we talked about.
That's great. Let's talk maybe a little bit about the timeline between close and actual value realization and what that looks like in some of the different, in the different scenarios we've been talking about. Maybe Amanda, you can chime in a little bit on tech and some of these tech platform plays, which are a bit longer. Scott, maybe a little bit on product and go to market, which can be a bunch quicker. Maybe Scott, we'll kick off with you.
Yeah, sure. We've, the interesting thing about some of the deals we've done is, one, very clearly, the product that they had gets sold to the people that we sell most of our products to today. And so that one is just really humming along. The first one we did, it's an adjacent buyer, still in the same kind of organizations, a subset of the organizations, but still it's a different buyer. So that one's been a lot more work. It takes, an overlay sales force as opposed to just being able to sell it to, our existing base. So those two differences and being able to identify those in a good way ahead of time, it really can make the difference between how quickly you realize that value. We knew both going in, we wanted to expand further across an organization, so that was the reason for the first one. And then the second one, it was, all right, let's just get this and we know who we're going to sell it to on day one, and every one of our clients can buy it. So it's, identifying what you want to get out of it and then executing on that.
And how did you maybe, just to take it a step further, set expectations with, the rest of your management team, your investors, your board, whoever else was, important about the different timelines and very different deal theses there? How did that go? Better, pros, cons, better, worse?
It's interesting because the biggest owner of us inside, they're kind of more venture-ish as opposed to private equity. So as they looked at it, they were very comfortable with both approaches. The first one we did, it was a company that we had helped found, actually. The founder of it worked for us. Then he started his company while he was working for us, and we supported him. And then he went off and did that full time. So that one was one that we knew what he was doing. We watched the progress, and so we got very comfortable with it very quickly. And so that was good. The other company we had been a vendor of for 5 years. And so we saw what they were doing. We loved the data they were able to provide to us because we aggregate all this data and pull it all together. And so again, it was kind of very natural in both instances. And then on the returns, they're both done very well. So it's not like one is floundering and the other isn't. And so I think when we had the conversations with the board, they were super supportive of both because they saw it as differentiating. The first one differentiating our target market, and then the other one as a boost to what we can offer our current clients.
Thanks.
That it's obviously different in technology, and especially if you're talking about really bleeding edge things that it may or may not be a return on investment conversation today. It's a functional requirement that you might need, that you see, you're trying to read the tea leaves 3 years out in an emerging tech market to say, no, this is going to be technology that is really going to enable this next thing when we get to the point where we can expand. We're going to need to have this. So I use a lot of capital, like human capital, I think, to back certain ideas when we're thinking about M&A of technology, players, because you have to be able to deeply understand your engineering organization. You have to believe in the roadmap. You have to know that the market's going to, hope that the market's going to support it. And then be able to convince investors that this is, you're constantly pitching a technology roadmap. So it's not so simple as, this multiple is going to yield, this value. You hope is a component of that, but it's, how do we make sure that it's sticky in the long term?
Maybe one more down the line question here. What advice would you give to CFOs who either haven't done M&A in a long time or really, don't have the track record, but are kind of looking forward and saying, this is where my organization is going? Joanne, maybe we'll start with you.
Hire good advisors. I think, lots of people don't necessarily have experience selling their company. I mean, many founders just build one company. So you need to partner with an advisor that's done it 100 times. And when we started the process at Patient Paying, I was begging our CEO, I said, please, can we please hire a banker? Because the first transaction that did not consummate, we didn't hire we hired a small consultant, but not a true banking company, and nothing happened. And so we did hire a banker, and I'd say that's pretty key if you don't feel like you have all the strengths, because they're going to advise the pitfalls, the ways to communicate, and kind of just really help the process for things that you might only experience a couple times through your career, but they're doing it every single day.
Probably the opposite answer, which is valuations are low, buy everything. And I think that's part of it, right? You know that these are calculated depending on how big, obviously, the acquisition might be, or if you're in a market like this where there's potential there, I would say you're trying to convince your CEO and management team that you're not going to win on every one of them if you're doing this. You're going to win some, lose some, play the spread, and that's kind of the whole game of it. But again, it's a different field.
And as far as the going off Joanne's point, the reaching out to colleagues who have done it. I think the other thing on the banker's point, bankers aren't doing a ton of deals right now, so they'll be super willing to help, as you think through this, because there aren't as many deals happening. And then the other point is, just reach out and ask questions to kind of anyone, and everybody in this room is probably willing to talk to everybody else in this room. So if you can start building that network and just getting like even asking one of the investment bankers, hey, what does a typical diligence list look like? Look at it now. Don't wait to figure out what the questions are going to be, when the test is there, right? Do a little studying ahead of time. And in that way, you can get yourself more comfortable with how that process will work. And I pick everybody's brain because you just learn something different from every person. And so the more people you talk to, the more advisors you talk to, the better you'll be able to inform yourself about the best way for your organization. So that's what I try to do myself, and that's what I'd advise.
Well, Liz, I'm glad you started down that side of the room, because I was going to say the same thing that Joanne said, but it probably wouldn't be as sincere because it's self-serving. But I think they've covered it well. Listen to that. I kind of liken it maybe to, you have a medical problem. Who do you want to go see, right? You want to go talk to the person who does this all day, every day. You don't want to be the test case for how to do an operation, right? So having gone through that personal experience myself. So I think that, just talk to your network of people who've done it. Be sure to hire good advisors, and that's not just financial. That can be accounting, that can be legal as well, depending upon what phase of the exploration process there is, and then the bankers help not just with, we help with we work with buyers all the time, be they financial, strategic, so we know what the focus areas are going to be for individual businesses. You want somebody who knows the sector in which your company operates, but also has a good M&A platform, right? Because that's what we do. And through that, they'll help with the materials, how to position the company in the best way to shine light on all the positive aspects, but also to help prepare for, be proactive in terms of some questions that an investor or buyer may have that may cause them some concern. So anticipating what those questions are going to be, preparing for those in advance, I think that's an important part of that process. And as I said, getting more information prepared sooner is going to position you better when you ultimately have those interactions with the buyer universe. And there's just no substitute for, doing your homework up front. I think that's the short version of it. So.
With that being said, I think we have about 15 minutes left. Would love to open it up to any questions from the audience. Yeah, maybe.
Yeah, this is an unfair question, but given the Twitter thing that's going on, given the Twitter event that's occurring, with your experience in M&A and post-acquisition, because we're only seeing the post-acquisition things that are occurring, where are the points of brilliance that you're seeing? Where are the red flags, and where is the points of befuddlement? Could you and then tie back to sort of your experiences and transactions, and what are your opinions there?
Sorry, what's Twitter?
Yeah.
Something happened.
Well,
we're
watching the Twitter acquisition.
That's a train wreck, right? I'm not sure.
And I'm wondering, are you seeing points of brilliance in the acquisition? Are you seeing just befuddlement? What is your assessment based on your experience having gone through post-acquisition activity?
Well, I think Twitter's a case study in what not to do, right? In the sense that he did no diligence, none, and signed a contract. I haven't seen that, like for a deal of that significance and size, right? And then, clearly he had buyer's remorse because he was trying to unwind it for a while and realized it's not going to happen. So I'm not sure I would necessarily focus too much on the Twitter example to try and take any takeaways from it, other than that's not the way to do it, truthfully. There was clearly no thought, as best as I can tell, as to what the post-Twitter was going to look like after the deal, right? Again, a case study in what not to really do. So I wouldn't spend too much time trying to get takeaways from that one personally.
Yeah, we also know from research, looking back at the last decade and a half of deals, that announcement effect, which I get is not 100% applicable here, but the learning is true, is actually completely uncorrelated if you look 2 years out at actual value creation from any kind of transaction or deal. So I think we're still far too soon to actually know where this story is going to end. And in the meantime, at least it's some fun news reading.
Yeah, and there's no real integration here, right? It's just an investor taking over for other investors, and he's clearly got his thoughts about what he wants to do, but time will tell, I think, is the honest answer.
Yeah.
And I'm not sure he's got it all figured out, is my sense.
Other
Going
questions?
back to when a company acquires another company and the founder is still involved, in your experiences, how often does the founder make it after? Let's say, is that part of the deal where the founder is on? I know, like, to make sure everything works, but let's say, how often is that a long-term arrangement as the plan? And then in those instances, how often does the acquiring company just get rid of the founder anyway?
Yeah, I'll take a swag.
Yeah.
I think more often than not, the founder eventually moves on, I think in most cases, because somebody who's a founder tends to be a very entrepreneurial person, and they want to run the show, and they're very creative, and they move on to something new. But they obviously, I think in most cases, want to see they want to take care of their people. They want to make sure that the combined company is moving forward in the right direction. But I think it's pretty rare that a founder of a business who's been acquired stays on for a long period of time. I think they generally move on after, there's no magic timeline, 6 months, 9 months, 12 months, that kind of thing. I don't know if you guys would agree, but.
Yeah, I think it can go well for some period of time. Usually, I would tie financial metrics to it, right? You build the earnout such that their interests are aligned with what the business is trying to accomplish. So, big fan of, incentivize the behaviors you want. That works with a founder you're bringing on as well.
I think it's a great point. Making sure that an earnout isn't tied to the diligence of their actual business, like of their, founded company's business case. That's a nightmare versus what Amanda said is like actually making it tied to true value creation as the acquired entity. And then I think the second thing that I ask my clients when I get asked this question is I say back to them, like, unless you can articulate an extraordinarily specific rationale for the founder going forward, like the right answer more often than not is to, how did you put it, Scott? Like support them in future endeavors. I think that tends to be what I see.
And actually, when I said that, I wasn't really being flippant. We probably will invest in some of these folks at some other point. So it is actually real too. Yeah. Like, you bet on them once, so it's not crazy to think you might bet on them again. And so I just wanted to clarify, I wasn't being jokey about that. We actually will help in case it gets back to them.
Yeah. Yeah, in the back.
So with all the, is this on?
Yeah.
With all the talk about what happens to the founders of acquired companies, probably just out of basic rational self-interest, what do you normally see for CFO change in control terms, or what happens with the CFOs?
We all gonna lay out what our change of control agreements are.
Like of the maybe 5 or 6 transactions that I've been involved with, usually the CFO of the acquired company is no longer at the company unless there's an unusual situation, like the company that acquired us. Their CFO was leaving, so they offered me a CFO spot. But in general, I don't think any company ever needs 2 CFOs. Yeah, that's what I've seen in my transactions.
Yeah.
I think there's a transition period typically, which will vary by the specific situation and relative size and on complexity and all that. The good news is for the CEO who ultimately is not the remaining, CFO, is there is I would argue, a dearth of good CFO talent in the market. And in talking and dealing with our financial sponsor clients, there is ample opportunity in the market to work with sponsors and portfolio companies and so on for a good CFO. I think a good CFO is frankly hard to find. Yeah. So, and I think it goes back to just, for somebody who thinks that this could be the deal where they need to then move on, just focus on doing your job, put your head down, and you'd be amazed at what comes out of that. Because if you in that diligence sessions kind of stand out and shine, your numbers, you're very fluent with the business, et cetera, that will not go unnoticed. And particularly when you're talking about if you're having a conversation with a handful of financial sponsors, especially who are on the other side of the table, they are always in the market for good CFOs.
Yeah. The 2 roles that I get asked about from clients for talent these days most often are CFO and finance org and actuaries. So that resonates a lot. I think one other answer to your question is, particularly in very large geographic expansion or cross-border deals, I see the CFO remain the market CFO and have, in many occasions, seen that person, if they've integrated particularly well into the parent and driven real outcomes, had a great success moving into the parent org more holistically.
I do think it's worth mentioning, though, like from everyone's a CFO, I'm assuming in the room, perspective that, if you're thinking that you're going to be shopping your company and you're going to be putting yourself in that kind of vulnerable position, there is, and it comes with quite a lot of work to get the company prepared and do all this. Hopefully everyone's making sure that they do have formal change of control agreements, right? So do protect yourself.
Yeah.
And when I was acquired by Intuit, this is 2013 or 2012, we didn't have formal agreements, but during that process, I was able to talk to a few people and explain to them the situation I was going to be in. And so Intuit ended up giving me a 6-month retention and then a 6-month payout if I stayed for that period of time for the transition. So that's one thing. And then, yeah, when you don't want to do it as far as negotiating, it's very hard, what the right point is. But there is a point where it's okay to say, hey, I don't have change of control on this thing, and there's a good chance I'm going to be out the door. So help me. Granted, at that point, maybe you have some leverage, maybe you don't. But having those good relationships ahead of time also helps have that conversation. Because usually if you've got a good relationship, then people, it's hard for people to look you in the eye and tell you to go pound sand.
Yeah, for startups, I would say for a CFO, you have to have single trigger, full acceleration on all of your equity, because if you're acquired and you're not offered the CFO equivalent job, then I think, just make sure you have that clause in your equity.
In the agreement, I mean, you don't have to wait and make anyone feel like you're being, untoward, but have that in your key employment agreement right out of the gate. If you're in an early stage company, would be my recommendation.
Yeah.
Other questions?
One other way to do that I've done is I'm going to be in on the first day of my work, and I'm going to see everything. And I've actually done this. I've said, I don't want to feel like a jerk when I walk in the door. So as you give me whatever, I don't want to be the highest paid person. I don't want to be way under. And I want everything to be kind of fair. Yep. And it's made adjustments to the original offer just by having that conversation. And it's not anything overly threatening or anything. It's just, look, I want to be kind of part of the team.
Great. Well, with that in mind, we are just about at time. Oh, there's one more. Sorry, I couldn't see that. I have a light.
Hi, my name's Alexis. I'm just wondering, when you're bringing teams together or when you're acquiring a company and absorbing their team, is there any suggestions on rally cry, how to make them feel comfortable as you're integrating? I guess I mean specifically on your finance teams too.
I think just being open and honest with people, as honest as you can be without, giving away information too soon. But if you're going to meet with them, and I don't know, I spend time with any of the finance folks that, if we're acquiring a company, I'm going and spending quite a lot of time there. So I think if you are doing that, and I'll bring some team members with me so they get a feel for what would the culture be like, who are the people you'd be working with, let them ask you all their scary questions. I think that assuages a lot of fears. I don't know if you feel differently.
Yeah, I think just, if I look at my team, we're always short, right? We always need more help. So if, the companies that we've acquired, they've been very small, so there's only been a person or two. And so it's easy for us to be able to take them on. That said, you still have to, hold them to a high bar, to be on the team. And so some people have, met that bar and others haven't, and that's okay, but we haven't just thrown them out the door on day one or anything like that.
Silence really creates a vacuum of total anxiety. And so communicating, here's what I know right now, and here's what I don't know right now, but I expect to know it at XYZ time, and I will get back to you at very specific X time. And even when that date comes, if you still don't know the answer, acknowledging that. I mean, it's basic, it's very basic stuff, but you can't imagine the number of organizations that don't kind of follow that playbook. And even if you're communicating almost nothing, but saying, I hear you, we're going to get back to you on this date with a drip and drab more, that actually turns down the volume on that level of organizational angst pretty significantly. Now I think we are at time. I want to thank our panelists so much, and really appreciate it.
Thank you, everyone. And thank you again to all the panelists and our moderator, who did a small gift from MIT for all of the folks. And there's going to be lunch served out in the hallway, so I know it'll be kind of a mass exodus, but And again, you're welcome to come up and say hi to any of the panelists too. All right, thank you.